The Dow is sitting around 46,200 right now, down 4, maybe 5% from highs above 50,000 just months ago. And if you've been watching the coverage, the analyst segments, the morning recaps, the "here's what moved markets today" breakdowns, you've heard the same rotation of explanations. Geopolitics, rate uncertainty, soft data, pick one, they all work. The problem isn't that those explanations are wrong, it's that they're not the whole story. And the part they're leaving out isn't a footnote. It's the part that changes how you should be reading this index in the first place. There are things baked into what the Dow actually is, structurally, mechanically, that make its current behavior look very different once you understand them. Wall Street has limited incentive to explain this clearly. Most retail investors have never needed to think about it before. That changes now. Before getting into what the consensus is missing, it's worth being honest about what it's getting right, because the bullish case is not invented. GDP is still growing. Full year 2025 came in at around 2.1 to 2.2%. Forecasts for 2026 range from 1.8 to 2.5%. Not a boom, but not a contraction either. The ISM manufacturing PMI has been above 50 for 2 consecutive months, which means expansion, not recession. Earnings from the Dow's 30 companies are still growing. Dividend yields and buybacks provide a cushion. The yield curve is positive, no inversion. These are real data points. The people calling for resilience aren't making them up. But here's where it gets complicated. The Dow is currently trading at around 23.7 times forward earnings. The long-run average since 1950 sits somewhere between 15 and 18 times. That gap between where valuations are and where they historically belong is not explained by the growth data. Solid but slowing GDP growth, a softening labor market, cooling consumer confidence. That's not the macro backdrop that typically supports a 23.7 times multiple. That's the backdrop that typically compresses one. The bulls have a case, but there's a flaw running through the middle of it, and the flaw starts somewhere most people have never looked: the index itself. Here's something most retail investors don't know, and Wall Street rarely bothers to explain. The Dow is price-weighted. That sounds technical. It isn't. What it means is this: Goldman Sachs, whose share price is roughly the highest in the index, carries about 11% of the total weight. Caterpillar is around 9.2%. Microsoft, a company significantly larger than both by market capitalization, carries only about 5.2%. That weighting has nothing to do with the actual size or importance of those companies. It's purely a function of their share price, which means the Dow is structurally tilted toward whichever companies happen to have the highest stock price. And right now, those companies are Goldman Sachs and Caterpillar. Why does that matter? Because Goldman Sachs is acutely sensitive to interest rates. Caterpillar is acutely sensitive to energy costs, industrial activity, and global demand. When those stocks move, the Dow moves, disproportionately. The index is not a neutral snapshot of the U.S. economy. It's a lens that happens to be pointed directly at the risks that are most elevated right now. Add the sector breakdown. Financials at 28 to 30% of the index, heavy industrials, tech at only around 20%. Compare that to the S&P 500, where tech dominates and has provided much of the earnings resilience that's propped up the broader market. The Dow doesn't get that support. Instead, it amplifies exactly what's fragile. So before you ask yourself whether the Dow's current level makes sense, ask yourself whether you've been watching the right thing. If you've been using the Dow as a proxy for market health, you may have been looking through a lens that systematically overstates cyclical risk while understating tech resilience. That's not a minor calibration issue. That's a structural blind spot. Back to that number, 23.7 times forward earnings. A PE ratio of 23.7 times is not inherently alarming in all contexts. In a high-growth environment with strong consumer demand, a tight labor market, and room for the Fed to ease, a premium valuation can be justified. The market is pricing in a future, and sometimes the future warrants the price. But the macro backdrop right now is pointing the other direction. GDP growth slowed to 0.7% annualized in Q4 2025. Unemployment is at 4.4% and trending higher. Job openings, as measured by the JOLTS survey, are down to around 6.5 million, the lowest since 2020. The University of Michigan Consumer Sentiment Index fell to 55.5 in March. That number historically correlates with weaker consumption ahead, not stronger. What a 23.7 times multiple requires is earnings growth that is strong enough and durable enough to justify paying that premium over fair value. That requires a healthy consumer, expanding employment, and a Fed that has room to support the market if things soften. None of those conditions are fully in place. Some are moving in the wrong direction. Stretched valuations don't automatically mean a crash. They mean the margin for error has essentially disappeared. Any negative surprise, a weaker than expected jobs number, a hotter inflation print, a cautious earnings guidance call from a major name lands harder at 23.7 times than it would at 17 times. The multiple amplifies the downside. And for a price-weighted index with heavy cyclical exposure, that amplification is not theoretical. There's a difference between risks that are acknowledged and risks that are priced. What follows is the second category: energy and geopolitics. WTI and Brent crude have been trading well above $80 in spots, with periods above 100. That's not a background variable. That's a direct margin threat for every industrial company in the Dow. More importantly, it feeds back into the inflation numbers the Fed is watching. Core PCE is already running at 3.0 to 3.1%. The Fed's models and the market's expectations assume energy stabilizes. If it doesn't, the one rate cut priced in for this year quietly disappears. The Fed's constrained hand. The Fed held rates at 3.5 to 3.75% at its March meeting. The dot plot, the internal projection of where officials expect rates to go, shows a median of just one 25 basis point cut for all of 2026. Some officials are projecting zero. That is not the policy backdrop the market narrative has been assuming. The idea that the Fed is poised to ease and provide support has become a psychological prop, one that rests on conditions the data isn't currently confirming. If oil stays elevated and PCE remains sticky, that single expected cut may get revised out entirely. The market doesn't seem to have fully processed that possibility. China and global demand. This is the quiet one. China's GDP growth and PMI are both soft. The property sector overhang hasn't cleared. U.S. industrials, companies with significant Dow weight, have meaningful exposure to Chinese demand. This isn't a headline risk right now, which is precisely why it deserves attention. The risks people aren't worried about tend to be the ones that move markets. Here's a direct question, and I mean it genuinely. If oil stays elevated through Q3, if the Fed holds or revises hawkishly at its June meeting, what do you think happens to a 23.7 times multiple on a cyclically exposed, price-weighted index? Put a number in the comments. I'm curious what you're seeing. These three risks in combination don't make the Dow uninvestable, but they do change the question. The question is no longer whether to be in or out. It's what scenarios are realistically on the table from here. Two scenarios, both conditional, neither a prediction. Scenario 1. The soft landing holds. GDP stabilizes around 2%. Energy pulls back toward the mid-70s. Q1 and Q2 earnings come in roughly in line with estimates, and guidance from major Dow components is cautious but not alarming. In this scenario, the Dow has a path to mid-single-digit total returns for the year. Call it 4 to 6% including dividends. Not exciting, but the buyback activity and dividend yield provide a floor, and the macro doesn't get materially worse. This scenario requires things to stop deteriorating, not improve, just stabilize. Scenario 2. Macro deterioration. Energy stays elevated. Core PCE edges toward 3.5%. The Fed signals at its June meeting that it's revising its rate path upward or simply holding with a hawkish tone. At that point, the compression on a 23.7 times multiple becomes the story. Historical precedent is not comforting here. The last time valuations were this stretched against a slowing macro backdrop, a 15 to 20% correction wasn't a tail event. It was the ordinary outcome. The 45,000 support level becomes the line to watch. The variables that will tell you which scenario is live: the May CPI print, the Fed's June meeting statement, Q1 earnings guidance from Dow Industrials and Financials, not the results, the forward guidance, and WTI spot prices through April and May. Watch those 4 things. They will tell you more than any analyst note. And one more question worth sitting with. Which scenario are you currently positioned for? If scenario 2 materializes over the next 90 days, do you have a plan? Or have you been assuming scenario 1 without checking your assumptions? The Dow at 46,200 is not a warning siren. Markets have stayed expensive longer than they had any right to, many times before. The risk isn't the number. It's the assumption underneath the number, that the Dow is a clean, reliable read on the economy's health, and that the story it tells is simpler than it actually is. It isn't. It's price-weighted, cyclically tilted, and trading at a multiple that requires a future the current data isn't confirming. Knowing that doesn't mean selling everything. It means reading clearly. This video is for educational purposes only and does not constitute financial advice. The analysis here is meant to help you think, not to think for you. Do your own research. The decisions are yours.